It certainly was a busy week for the banks, but I really want to start with this story from Nvidia. And it is really mind-boggling, the valuation that the market has put on it. Well, I guess it's not mind-boggling because of what they're delivering, but the value of Nvidia is now over $5 trillion.
That is incredible. Yeah, when we think about just how much they've grown over the years. I mean, how many people, except for outside of maybe the gaming community, just 10 years ago had even heard of Nvidia? Because that's really where they made their bread and butter. It was with these gaming chips and that. And then
they not only made bread and butter, they make chips.
That's right.
And,
it's
most people, if you ask them, and I think they're a tech company, well, they make these Blackwell chips are so fast that they really, I don't want to call it a monopoly, but there's no one else who can do what they do.
That's right. There are some who are trying to get into that, and that actually helped drive the stock price for a few firms. If we think about like Broadcom, they announced that they were going to try to be competing in there. There are Qualcomm
is so they're going to get into the business
with the they're most known for like the cell phone chips that they do. They're trying to get into it. So we'll have to see how long this monopoly that they have lasts. But right now, they are the number one player in there.
So you're okay using the term monopoly, huh?
I only because if they are the dominant provider in that particular market, the only ones who make it, yes. But I don't necessarily think it's inherently a bad thing because it's a contestable market in the sense that Qualcomm, Broadcom, these companies are going to compete with them. You even look at some of the customers of Nvidia, like Amazon. They're developing their own chip. Google or Alphabet, they're also developing their own. I'm sure all these companies are trying to compete for that. So monopoly is sometimes a dirty word, but it doesn't have to be because there's still that competition. There's a big barrier to entry, but it's not as though it's like insurmountable.
So let's have a conversation. A lot of people are hearing this and saying $5 trillion for one company. It certainly sounds like a risk, correct? And so, they'll hearken back to what happened in the late 90s and into early 2000 when there was this tech boom and then bust.
Yeah.
The change that I think exists today that didn't exist then, those were concepts. They were ideas that people were selling. This is a real company with real sales and real profits that we can put a valuation on.
Well, and that's the key thing, is you don't have to really bend over backwards and invent new valuation metrics. Back during the tech bubble, it was price to eyeballs was one of these metrics that people were using. And now you can still do it based on price to cash flow, earnings, because they have it. Keep in mind also that the tech bubble and then the burst, a lot of it was driven by leverage. A lot of these companies, they weren't making money, whereas today they are. They also had a ton of leverage back then, whereas today these are companies that sometimes have net negative leverage, meaning that they have more cash than they do debt, so they could easily just pay it off.
Net negative leverage, right?
Yeah, very different setup.
Those investors back then, they still have PTSD because of what happened in 99. And then at the end of that decade, 2008, we had a great financial crisis. So I'm not surprised that people say, is there risk involved? And when you have the top 7 companies representing nearly 25% of the market cap, it's a reasonable conversation. And so you see there's other companies that are doing well. On Friday, Amazon hit it out of the park.
They did. And Amazon is so interesting if you think about where they came from, right? Selling books online, being delivered, and now everything they do. Fastest growing part of the business is Amazon Web Services.
AWS.
AWS revenue there was growing very rapidly. I think it's the fastest that it's been in like 3 years. So the take up by businesses to subscribe to their service. But even their traditional retail channel is doing well now that they've entered into delivering fresh produce and food. That's kind of a newer line of business for them. That seems to be growing rather rapidly. Again, it boils down to it's the cash flow that they're generating. Now, think about during the tech bubble, Amazon was one of those companies that was caught up. It was in the bubble and then the bust because people are like, they're not making any money. And that was like this meme going around is that, well, when are they ever going to make a profit? Well, it just took a little while.
Right. And you think about what happened back then, ICE.com and all these crazy ideas that were going on. But you think about Amazon as a disruptor. So, they, of course, the Barnes & Noble Amazon story. Well, now they are displacing all kinds of other operations and family operations and stores. There's an argument to be made that, at what point is it too much, right?
Yeah.
But either way, the two tech stocks that we talked about, which bleed into other companies, have been the story. Now, Joe talked about at the beginning that it was a big week for central banks, and we're going to have to cover that. But as expected, the Fed cut rates.
They did. It was widely expected that they were going to cut. Also, the announcement that they were going to stop shrinking their balance sheet. So if you think about that quantitative tightening, as it's called, where they're allowing their balance sheet to get back to what they consider more normal
by
levels.
Just shrinking it, right?
Yes.
So when they say, how do they do that? They just don't buy more bonds when they come due.
Exactly, because it's not as though it's like a household's balance sheet where you have like real estate and stocks and things. Most of their balance sheet are bonds. And bonds, they have a set maturity. And so all they do is basically when the bonds mature is they just stop reinvesting the proceeds, and it just sort of naturally shrinks over time. And that's what they've been doing for over the last 3 years. There were some signs of some stress forming in the short-term money markets where nothing all that worrying, but they didn't really want to risk something like back in 2019. There was a period of time towards the end of the year where all of a sudden you saw those overnight rates really go off the charts.
Right.
So they wanted to avoid any sort of issue. So they're like, hey, let's just kind of call it to where it's good. The big surprise was where Chair Powell really forcefully said that a December rate cut is not a foregone conclusion.
Right.
And it's like, well, it's never a foregone conclusion because things can change. But just how forcefully he said it and how many times.
A shrug of the shoulders, as you said earlier
That's right.
in the week.